When a financial headline calls 5 Singapore stocks core dividend stocks to buy and hold, most people focus on the company names, not on what those stocks actually pay today. My job is to track what the broader market is saying before Iggy runs the forensic numbers. And today, I am looking closely at what these 5 companies actually pay you right now. 2 of them pay a lot less than the word core suggests. All 5 names on this list are good businesses, but 2 of them pay you less today than that word core implies. That gap is worth sitting with before you buy anything for the label alone. The headline reads 5 core Singapore dividend stocks to buy and hold. The real question is simpler than that. Do you check what something actually pays you, or do you just trust the name on the label? Let's look at what the original article got right first. The smart investor built this list around a genuinely sensible idea: own resilient businesses, not the highest yield you can find. Chasing the highest starting yield is how people end up owning shrinking businesses, propping up a payout that will not last. Building a portfolio around dependable holdings spread across different sectors so no single one can sink you is sound thinking. That part 1 do not disagree with. The 5 names are DBS Group, ST Engineering, Singapore Exchange, Sheng Siong, and CapitaLand Integrated Commercial Trust, or CICT. ST Engineering has paid uninterrupted dividends for over 20 years, with an order book of $34.5 billion. Sheng Siong is sitting on over $400 million in cash with zero debt. CICT grew its net property income close to 8% year-on-year and is pursuing the Paragon acquisition. These are not shaky companies. There are really 2 separate questions here. First, is this a well-run business with quality and a track record behind it? Second, does it pay me enough income today at today's price? A business can be excellent and still be the wrong income holding for where you are in your own timeline. Let's start with DBS. DBS had a genuinely strong first quarter of 2026. Record total income of $5.95 billion, net profit up to $2.93 billion, return on equity at 17%, excellent for a bank this size. The board raised the quarterly dividend to 81 cents a share, up 8% year-on-year. On paper, that sounds generous. Look closer at that 81 cents and it is actually 2 things stitched together. 66 cents is the ordinary dividend tied to core lending profit. 15 cents is a separate capital return dividend reviewed on its own timeline. Against today's share price of around $73.94, the ordinary yield alone works out to roughly 3%. Add the capital return portion and it climbs to just over 4%. 3 to 4% sits in roughly the same range as my own fixed deposit, and my fixed deposit does not come with share price risk. If you are buying DBS for the quality of the franchise, that is a defensible decision. If you are buying it specifically because you need income right now, and the word dividend stock made you assume it pays generously, that deserves a second look. That 15-cent capital return is a genuine, board-confirmed commitment, so it is fair to count it in your total income today. But it is still a different thing from the ordinary dividend, funded differently, reviewed separately, and easier for a bank to slow or end than a payout tied to core lending profit. The 81 cents is not one number, it is 2 different promises stacked together. Know which one you are actually relying on. My husband likes to remind me of this every time I bring up a stock at dinner. His fixed deposit pays a guaranteed rate, no surprises, no drama, and honestly, no excitement either. He is not wrong to bring it up. DBS's ordinary dividend on its own without the capital return portion lands in roughly that same range today. The difference of course is that a fixed deposit sits there quietly while DBS comes with real share price movement both up and down that a fixed deposit will never have. I do not say that to scare anyone off DBS. I say it because the comparison only means something once you actually run it side by side, rather than assuming a bank dividend and a fixed deposit rate are somehow answering the same question. They are not. One is a guarantee. The other is a bet on a good business, priced fairly today. Whether that trade-off is worth taking depends entirely on what you are actually asking your money to do for you this year, not on how comfortable the word dividend sounds on its own. Singapore Exchange had a strong half-year too. Net revenue up 7.6%. Securities trading value up close to 20%, and management has committed to raising the quarterly dividend by a quarter of 1 cent every quarter through the end of financial year 2028. A quarterly step-up is a direction, not a level. The real question is what today's dividend rate actually comes to against today's share price, not whether the direction sounds good. At $23.65 a share, SGX's own forward dividend guidance works out to roughly 1.9% a year. Starting from under 2%, it takes a long run of those small quarterly increases to reach a level that would actually replace meaningful income today. Direction and destination are not the same thing. This reminds me a little of my old pharmacy days. A medication can be genuinely effective and still be the wrong dose for a particular patient. SGX being a well-run exchange with a rising dividend does not automatically make it the right income dose for someone who needs cash flow starting this year. A rising dividend trajectory tells you the direction management wants to go. It does not tell you where you are starting from today. That starting point is what actually shows up in your bank account this quarter. If a stock story is, we are committed to raising this over time, the honest next step is to check what that is worth right now, at today's price, before deciding whether it already meets your need. A few of you have asked what it is actually like inside IGGY'S elite investors. Honestly, the biggest difference is timing. Free subscribers are reading about a move after it has already happened. Members are comparing notes on what is coming next, together, while the rest of us are still catching up. For $9 a month, elite investors get 0-day access on Substack and YouTube, the full Red Zone watchlist, and institutional-grade cheat sheets. That is less than a coffee and kaya toast set at Raffles Place. The other 3 names on the list do not carry the same gap. ST Engineering has formalized a progressive dividend policy, passing roughly a third of year-on-year profit growth to shareholders. Sheng Siong's free cash flow grew close to 60% year-on-year, funded entirely from its own cash. Zero debt. CICT's occupancy sits above 95%, with rental growth over 4% for retail and above 6% for office, from actual lease renewals. None of these 3 raise the same question DBS and SGX do, whether the label is doing the work the numbers should be doing. Worth knowing that difference exists, even within one list of 5 names, all filed under the same core heading. Quality answers whether a company deserves your trust. It does not answer whether it pays you enough income today, at today's price, for what you specifically need your money to do. DBS and SGX are both excellent businesses. Quality is one half of the answer. It is not the whole answer. Pull up the actual dividend. Pull up the actual price. Do the arithmetic yourself. It takes 2 minutes, and it is the difference between buying a great company and buying the right holding for where you actually are right now. I only picked up this habit properly after retiring, checking the actual number against the actual price rather than trusting the label. It is a small discipline, but it is the one that separates a portfolio that quietly funds your life from one that just looks good on paper. Both DBS and SGX are companies I am genuinely glad exist on the Singapore market. Neither of them did anything wrong here. They had good quarters, they are run well, and if either one is already sitting in your portfolio, that is nothing to panic about. But whether either one belongs in your income column this year, specifically the column you are counting on to actually pay for something, is a question only your own numbers can answer, not a headline calling them core, and honestly, not me either. I can hand you the arithmetic. I cannot tell you what your own retirement needs to look like this year, so here is what I would actually do. The same thing I did before writing this. Pull up what you own. Pull up what it paid you over the last 12 months and pull up what you would pay to buy it today. 3 numbers, 2 minutes, and you will know exactly which column each one really belongs in. That is the habit, not distrust of good companies. Just the discipline of checking before you assume the label already did the work for you. Angela's content summarizes publicly available market news, analyst research, and earnings data for informational purposes. Iggy provides the investing iguanas forensic ratings and analytical verdicts. Angela's role is to recap noteworthy developments across the SGX market without applying analytical filters or investment recommendations. Always read primary sources and consult a mass licensed financial advisor before making investment decisions.